We're going to talk about something fun today. And if you're feeling a bit tired, I'm going to try to wake you up by, let's do a raise of hands. All right? So the question is, and I'm actually interested to hear what you guys think about this. Can Ethereum compete with Bitcoin as hard money? If you think yes, raise your hand. All right, I suppose Ethereum can, of course. I mean, it can, but perhaps a more interesting question is, will Ethereum compete with Bitcoin as a hard money asset? Let's do another raise of hands. I'm just showing you how you raise your hand. I'm not actually raising my hand for that purpose. And perhaps it's a bit rude of me to... So a little bit about myself. My name is Eric Wall. I am a hedge fund manager for a Scandinavian cryptocurrency hedge fund. The company is called Arcane Crypto. It is a publicly listed entity in Scandinavia. I manage the hedge fund for that entity. And I'm a computer scientist in education, but I manage a hedge fund, so I've pivoted into finance, basically. So I want to talk about hard money and what it means. So this is a gallon of milk. And you can look at, in 1930, a gallon of milk costed 30 cents. And now it costs $3. So it increased in price by 10x. But since the 1930s, we have gotten extremely better at producing milk. There's much more milk that we can produce much more cheaply now. So realistically, the price of milk should be cheaper. It shouldn't be more expensive. And if you compare, for example, the price of a gallon of milk in gold, then, well, the price of a gallon of milk has dropped by a factor of 10 instead. So there's about a 100x difference there. Instead of increasing 10 times, it's actually dropped 10 times. And it, of course, has to do with the denominator. So dollars are not hard money. And the premise of Bitcoin and cryptocurrencies, scarce assets that have fixed supply, they should increase in value over time. Actually, they should increase. The GDP is not a perfect metric of how much these assets should increase over time, but it's as close as we can get. But if you look at the purchasing power of the dollar, it's been decreasing. So the GDP is growing by 3% each year on average. I ran the numbers. And the purchasing power of the dollar is decreasing by 3% each year. So it's really when you think about how much modern fiat monetary policy is actually suppressing the value of the currency, it's not 3% each year, because the currency is supposed to gain 3% per year. So it's that difference that monetary policy is actually suppressing. So it's about 6% that we are losing with the current modern fiat monetary regime. So how do we solve this problem? How do we invent hard money? And this is a quote from Friedrich Hayek in 1984. He talks about, well, we're not going to be able to change the fiat system, but what we can do is we can introduce something in a sly, roundabout way that they can't stop. And that is, of course, cryptocurrencies. That is the sly, roundabout way that we are creating something that they can't stop. So what's the promise of Bitcoin? Well, the promise of Bitcoin is that we're going to mint a bunch of them, but after some time, we're going to stop minting Bitcoins, and it's going to be 21 million units, and we're never going to go beyond that. So that's how we're going to create a hard money asset. And the interesting thing here is that if you take a currency like Bitcoin, and let's just assume that Bitcoin, there's no speculation in Bitcoin. This has nothing to do with the price of the value of Bitcoin going up because more people are investing in it. I'm just comparing here the natural value appreciation of a currency that grows with the rate of GDP versus a currency that has as its target to lose 3% of its purchasing power per year. And in less than 25 years, you would be 4 times richer if you had the fixed supply asset versus the dollar. So that's in less than 25 years, it's a 4 times difference. So that's what we want. That's the kind of money we want. That's why Bitcoin is interesting as an investable asset class. So how do we go about inventing hard money? This is a picture from Murad Mahmoudov. I think it's a very good explanation of how Bitcoiners think about how we reach the ultimate state of universal hard money, global full money. So it starts with a speculative asset, a digital collectible, and then as the value appreciates and the regulatory climate needs to take a stance around this assets, we gain more regulatory clarity. As we gain more regulatory clarity, the volatility goes down. And as the liquidity improves and we have better custodial solutions and we have better tax regulations, it might turn into a reliable store of value, something that you can store your wealth in. And once you have this digital gold asset, wouldn't it make sense? I mean, Bitcoin is intended to be transmitted easily around the internet. So if you are comfortable with storing your wealth in Bitcoin, wouldn't you be comfortable with also paying in Bitcoin? So that's how we also start to embark upon the medium of exchange use case. And the medium of exchange use case, like if you look at an asset class like gold, it's around $10 trillion, $9 trillion. But the value of fiat currency, globally speaking, is in the magnitude of $100 trillion. And if you now imagine, and you have to keep in mind here that fiat currency is something that people don't want to hold on their balance sheet because it's designed to lose value. What if you instead had a money that increases 3% in purchasing power each year, that could double in value in 25 years? Maybe the incentive to go put all your money into real estate, stocks, you could just be happy storing your wealth in money because it's good money. And if you look at the premiums in real estate and stocks, like how many people are just investing in these things to preserve their value, to escape the debasement of fiat, if we reason in those terms, the ultimate market cap of Bitcoin could be closer to $300 trillion if we actually achieve this ultimate goal of hard money. And if somebody's good at doing math and thinking about, okay, so what does that translate into a unit price for Bitcoin if we have 21 million units of Bitcoin? Well, it's around $15 million per Bitcoin. So that's of course, very good. I'm not going to give people false hopes here, but that's the goal, right? So what's the relationship with Bitcoin and Ethereum? Because this is what the talk is supposed to be about, right? If we go back to 2017, Ether was actually not described as a currency. It was just described as something to be treated as crypto fuel, a token whose purpose is to pay for computation in the Ethereum virtual machine. So they never branded themselves as a currency initially. So what's happened since then? Well, one of the big things is that Ethereum is transitioning to a new consensus mechanism called proof of stake. And that appeals to a lot of people because, well, there are some people that believe that proof of work is extremely energy intensive. I recommend this. I recommend for those who don't understand why there may be arguments against that to speak. It's a good water cooler discussion, but we don't have time to cover that today. There's both pros and cons of proof of work from an environmental perspective. But really the interesting thing with proof of stake, apart from being an ESG compliant consensus mechanism, it's also that you can, with less of a security budget, and when I say security budget, I'm talking about how many units does the protocol need to mint in order to secure the blockchain. Proof of stake is leaner in that way. You can, with less issuance, like less inflation, monetary inflation in the protocol, attain a higher degree of economic security, which means that you can settle for, let's say, you could secure the protocol with just 0.5% inflation each year, because proof of stake, and the intuition here is that with proof of work, you actually have to build these mining equipment, and you have to burn electricity, whereas in proof of stake, you just lock up liquidity. And the amounts of liquidity that you can lock up there becomes much larger than in the case of proof of work. So right now in Ethereum, there's around 7 million Ether locked up in proof of stake. That translates into $27 billion. And you need 2/3 of that to attack the system. So really, it's $18 billion at stake in Ethereum right now if you wanted to launch an attack. And they do that with just 0.5% issuance per year of new Ether. And there are other things that there are other ways in which Ethereum differentiates itself from Bitcoin. Look at the fees that Ethereum, the Ethereum blockchain, generates compared to Bitcoin. $48 million a day in transaction fees. That's because, I mean, Ethereum it does so many more things than Bitcoin does. It's this open, permissionless fintech platform where you can trade assets. So I think around 7% of all the trading activity for Ethereum on decentralized exchanges versus centralized exchanges, about 7% happens on-chain on Ethereum. So that's the reason why these transaction fees are very high. There are arbitrage opportunities, there are lending protocols, there are leverage protocols. There's so many things to do, so many activities to engage with, and also participating in NFT auctions. So the fees are much higher. But do we really need, I mean, Bitcoin is secure, right? And Bitcoin is secure with $700,000 a day in reward for the miners in transaction fees. Do we really need $48 million per day to secure the Ethereum protocol? It's a bit much. And with the EIP 1559, it was an upgrade to the Ethereum protocol in August. We are now burning approximately 80%. We're now burning approximately 80% of the transaction fees in Ethereum. And with the combination of burning the transaction fees and proof of stake, the supply of Ether is actually decreasing over time. If you run the simulations, and I've spent some time running the simulations on what the ultimate net issuance of Ether could be when you take into account the transaction fees that are getting burnt and the proof of stake consensus mechanism that requires less of issuance to secure the protocol. And when I've run these numbers and looking at the current data, it's not at all weird to expect that we would have maybe even 2%, minus 2% net issuance in the Ethereum protocol, and the system would still be secure because we are burning so much of the transaction fees. So if the Ethereum supply is shrinking by 2% each year and the Bitcoin supply is just static, what does that, if you run those numbers and you look at, okay, so what's the value appreciation going to look like here with a shrinking supply versus just a flat supply? Well, now you don't only have 4 times as much versus the dollar. You reach 6 times, more than 6 times. Ether could appreciate in value 6 times more. The difference between if you held dollars versus Ether could be 6 times in less than 25 years. But there's more. There are more things here. So in Ethereum right now, you have rollups. I don't know if you know about rollup technology. It's basically a scaling mechanism for Ethereum transactions that are, the user experience is better than, if you have used these tools, you're going to notice that the user experience of rollups is much better than Lightning, in my opinion. So it might become a more prolific transaction mechanism. And we also know that there's tons of DeFi activity happening on the Ethereum chain, which is making it the more active chain. And the NFTs, it's very hard to get something like Bitcoin or Ethereum to be the native currency for an economy. But in the NFT space, people are actually transacting with Ether. So, and apart from that, if you look at something like stablecoins are proliferating on the Ethereum platform, but they're not on Bitcoin. And that means that we might have payment rails that might emerge on the Ethereum system for stablecoins that may later translate into also payment rails for Ethereum. So the narrative here is basically that Ethereum people don't agree that you necessarily need to follow this trajectory that I was speaking about earlier. They say that we can just focus on the medium of exchange part and just make it as usable as possible, and then it's going to become a store value. And they also don't really believe that Bitcoin, with the low transaction fees that they have, when they are no longer issuing more Bitcoin, they are unsure whether that's going to be sufficient to create a stable, secure blockchain. So the last question I'm going to go into here is that why doesn't Ethereum have a leg up on Bitcoin money? Is the predictability of this issuance rate. In the Ethereum community, they are always tweaking the parameters of the issuance rate. They call it minimum viable issuance to keep the system safe. But it also means that you don't actually know. You don't really know for sure what the issuance is going to be in the future. And that is causing a lot of concern for people. Like, how do I know that the issuance rate is going to be minus 2%? You don't really know that. It's up to the governance of the Ethereum protocol, and they have a tendency to change these parameters, which causes an attack vector. If that governance process gets infiltrated by, let's say, government entities or something else, it doesn't really adhere to the properties of sound money. It's not like gold, where it's limited with how much gold you can dig out from the ground. So, conclusion. Can Ethereum compete with Bitcoin as hard money? I think yes, it can. I mean, of course it can, and it probably will. The question that remains, I suppose, is whether it should. I personally think that the main innovation that we have been able to create with cryptocurrencies is that we have been able to create digital scarcity. And we have been able to create something that resembles digital gold. But how can we make the argument that we have invented the digital gold if something else comes and replaces that digital gold? That doesn't really happen with gold. Gold doesn't find, it's very unusual that another precious metal comes around and replaces gold. If that happens in the cryptocurrency economy, that the number one gets replaced by another cryptocurrency, then people are going to start to lose faith in that we've actually created anything that resembles digital gold. And even in Ethereum, Ethereum has a lot of competitors as well. There's Solana, there's Avalanche, there's Hedera Hashgraph, there's tons of all these other ones. And what happens then if Ethereum gets replaced by something else? If that's the case, then how can we even describe these assets as store value? How can we even say that we've invented a digital form of gold? And if we haven't invented a digital form of gold, something that you can preserve your wealth in, who's going to invest in this? How are we going to reach a $300 trillion market cap if people aren't investing? I just want to finish with this. So I have all these opinions about Bitcoin and Ethereum and why it shouldn't become a hard money, why it shouldn't become a hard money asset. But it's not up to me. It's not my decision. My opinions on this matter are irrelevant. It's up to what other people consider is good. And I just want to finish with some last closing remarks that I had written down. So, ultrasound money with no carbon footprint is a batshit powerful meme. It's not a matter of opinion, at least not your opinion. Your opinion doesn't matter. It's other people's opinions that matter. We are all slaves underneath the burden of other people's good memes. So you can reject the meme, you can dismiss the meme, you can debunk the meme, but never underestimate the meme. Only think, how good is this meme? And rather than thinking, how correct is this meme, when assessing your opponent's power level. And that's all I had. Thank you very much.